Black markets are awaiting the results of Nigeria's 5-year bond auction today. That's on the sidelines of President Goodluck Jonathan's state of the emergency, of course, in the northeast. And then, on the other hand, Ghana will be issuing a second Eurobond to restructure existing debt. So let's take a look at issues around raising capital in West Africa. Roy Daniels, head of African trading at RMB, joining me at the desk. Roy, thanks so much for joining us. So, of course, it is concerning what's taking place in Nigeria, and we see strong action coming through from the government there. A state of emergency declared, everyone on high alert. That being said, do you see this having any feed-through effect to the financial market?
Well, it should have an effect on their markets. I mean, we would assume that based on what we're seeing about the state of emergency, and the picture's looking bleaker and bigger and a bigger problem as the days go by. So it should have an effect on it. Having spoken to our guys in the local office up there in Lagos, they felt pretty much the same way. They're waiting to see the impact that would have on the 5-year bond auction. And the biggest thing is look at what is the offshore investor interest into the 5-year auction. The currency, surprisingly very stable. There is a lot of sort of ignoring the problem because it's sort of in the northeast of the country, but it's now spreading. Initially it was a small problem, it's becoming a bigger problem. When you reach...
And a problem certainly that has not gone away at all.
No, and they don't... I don't see them work... I don't see a solution to the problem. You have a state of emergency. I mean, that might annoy more people in the area. You certainly know that the governors from the area are not taking to that news very well. So it should have a negative impact. I mean, will it stretch down to the rest of Nigeria? The feeling is that it won't. It'll stay isolated up in the northeast. So it's a matter of kind of wait and see what effect the state of emergency has. But I do believe that investors might start looking and saying, hang on, how big is this problem going to become?
And of course, as you say, the latest bond auction will be a signal of that. Does this mean that you take a kind of position on Nigeria at this point in time? Do you start, because this has been a market you've been quite excited about when it comes to the returns you can get from the market there?
Well, last night, if you'd asked us, are we going to go into the auction, certainly from our trading desk in Joburg, we would have said yes. This morning, however, given the news has come out, we're now very cautious, and we didn't go into the auction this time around. We're happy with what we're holding at the moment. We have a flexible position that we can go out of. So we want to keep it that way until we see how this dust settles. And that might be a stance that other investors might follow as well.
Let's talk about Ghana, because Ghana is trying to issue a second Eurobond. This time they're looking to restructure existing debt. When you see something like this coming through, because there's so much excitement around countries in Africa listing their first Eurobond and debut Eurobonds, but if the second Eurobond is around not being able to manage current debt, surely that should be a worrying signal.
I think it's a little bit concerning that in 2009, they announced they're going to have a sinking fund to collect dollars, a sinking fund being an account that uses funnel excess dollars into to try and repay the 2007 bond due in 2017. That was in 2009. To date, the sinking fund hasn't started. So now they're going to issue another bond to restructure some of their debt. I would say, given what we're seeing in Ghana, we see that the high public sector debt, and this is around public sector employment.
What's really driving that high public sector debt right now?
I think it's just number of employees. I think they looked upon their unemployment. They looked at their situation in government ahead of elections, provide employment for people. Now these people employed, you've now got to keep them on board. So the public sector debt is driven by the public sector wage bill. So that stays in place. And given what we're seeing in Ghana, oil production not being as high as was anticipated, you would say, looking at those factors, that the sort of buying interest from offshore should remain flat as a pancake or as whatever. So, but given the demand we've seen right the way through the rest of the Eurobond issuances, I'm sure there will be demand as well. So we do anticipate demand coming through. I think the key thing for Ghana is the timing of the issue. So if they issued just after Angola issues, I think you might see less interest there. You'll see more interest in Angola. We like the prospect of the Angolan issue. So I think Ghana will have muted sort of interest, but again, I think it'll be oversubscribed. It's a case of them just carrying on with the whole sort of flow across Africa, looking at the demand for these Eurobond issuances.
I mean, looking at their 2007 Eurobond, which of course was the 10-year Eurobond, $750 million is what they raised. That's now trading at 4.96%. Do you think they'll be able to issue this Eurobond at a similar yield? Or, I mean, the secondary market will trade at around those levels?
Well, given the sort of yields we're seeing for the other countries that are out there, they're trading sort of around 6%. I think it's going to have to come in at a slightly higher rate than that. The demand at the issue again will push the rate slightly lower, but I think it's going to be at the high end of the rate.
Does the story not highlight concerns around getting exposure to Ghana, even though yields are so attractive?
There are concerns. We've listed them out there. I mean, are there concerns in Angola? Should there be concerns in Zambia when they issue their Eurobonds? Probably less concerns, but still concerns. So I think given that the concerns that are there, is it manageable by the government? I think the government is managing the problem. It's not like it's a problem that's running out of control for them. So they are managing their problem. They are managing their debt. There is scope for oil production to pick up. So overall, I think it's not an ugly, nasty picture sitting in Ghana. I just think that given what's there, you won't see the oversubscription levels that we've seen in some of the Eurobond issuances.
When it comes to, let's just look at dynamics around playing into inflation and rates in Ghana right now. You've got the cedi, which is down month to date, and it's had a bit of a rough year. Policy rate there sitting at 15% and inflation 10.6% year on year in April. So inflation continues to trend high. In fact, it's at its highest in 3 years. Do you see rates having to respond to this in light of the fact that you've got also a currency week?
I think if you look at the yields in the bonds, they probably trade at around sort of 18 to 20%, sometimes 21%. So I think the yields are high enough. I think inflation's got a little bit of room to kick a bit higher from here before impacting on the rates that much. When you look at the Ghana investment on the bond side, if you buy a Ghanaian bond and it's yielding you 20%, do you see the currency weakening 20% in the year? And our guys at RMB and our research team, they don't believe we're going to see a weakening in the currency to that extent. I think we've had that huge weakness in the currency. It's hit them, and it's now being fairly well controlled or managed, should I say. So if we looked at that, we'd say you could still buy the bonds. You'd still come out net positive. It might not be as much as you were hoping for it at 20%, but you probably come out with 10% on the yield anyway.
So the returns there are attractive enough to discount for a weaker currency. So Ghana, Nigeria, put the two together, where rates in Nigeria, of course, lower than Ghana, but you've got this rising security threat to the country. Anyone that you rate as slightly more attractive if you're looking to get exposure through the debt market?
I think given the size of the Nigerian economy, they'd always be the favorite. I don't think anyone's going to have an African fund or an emerging market fund that has a strong Africa flavor to it that's not going to have Nigeria. It's almost must have. It's like having an Africa fund without South African exposure. You can't do it. You've got to go there. You've got to go to Kenya as well. We've heard the comments early on around Kenya. So the three key markets in Africa, Kenya, South Africa, Nigeria, you've got to then be looking at those three continents. You'll always be adding to it. Ghana kind of sits there, nice yields, looks attractive, but I don't think you're going to have the same level of exposure or investment from offshore into Ghana as you see into Nigeria. Nigeria offshore investment is huge. It's running into the billions of dollars. And
what's going to be the catalyst for Ghana then to get those foreign investors in?
I think we've got to see the government spending coming down. I think we've got to see the government spending at a lesser percentage of their GDP. I think it's a key thing. Oil production is key. It takes away the reliance on the cocoa crops. Those are the key things, I think, for the Ghana to look more attractive. Even when it looks very attractive, it's not going to hit Nigeria's eyes.